secret that, if you told it to an average person, they'd laugh and tell you to stop watching so much TikTok. But it's true. Banks don't just hold money. They create it. Not with printing presses like in Hollywood movies, but with numbers. A signature. A transaction. And every time it happens, your world shifts quietly. No announcement, no warning, no explanation. Yet the entire economy moves around that single click. If you've ever wondered why housing prices soar while salaries don't, or why money seems to exist even when nobody ever actually sees it, this is where the story begins. There's a quiet trick happening in the background of your life. Not the kind of trick pulled by magicians with gloves and doves. I'm talking about a trick performed by the most powerful institutions on Earth. Right in broad daylight. A trick so normal, so boring, that almost no one questions it anymore. Here's the paradox. When you put money in the bank, you think the bank stores it. But the moment your back is turned, that money doesn't sit in a vault. It doesn't wait for you. It's gone instantly reincarnated into someone else's mortgage, someone else's business loan, someone else's dream, or their disaster. And somehow, your balance doesn't change. Their balance increases. And the money supply grows even though no new money was printed, minted, or mined. It sounds like alchemy. It sounds illegal. It sounds like the financial equivalent of multiplying bread and fish. But no, this is the everyday machinery of modern banking, the engine that built nations, destroyed others, and quietly shapes the rhythm of your life. So, today, we're pulling open the curtain on one of the most misunderstood systems in the modern world. How banks actually create money from nothing. To understand how banks create money today, you have to rewind the tape not to Wall Street, not to the Federal Reserve, but to a group of surprisingly ambitious goldsmiths in 17th century London. Back then, people didn't trust kings, governments, or neighbors with their gold. But goldsmiths? They had vaults, thick walls, guards, professional paranoia. So people paid them to store gold safely, and the goldsmiths handed out paper receipts claims on whatever amount you deposited. Then something odd happened. People rarely came back for their gold. Gold just sat there quiet, heavy, and lonely. The goldsmiths noticed two important things. 1. Most gold was never withdrawn at the same time. 2. People were starting to trade the paper receipts instead of gold. That's when the first twist in financial history appeared. Goldsmiths realized they could issue extra receipts more than the actual gold in their vaults lend those receipts out, and collect interest on gold they didn't even have. For the first time, money existed without metal behind it. It wasn't backed by gold. It was backed by trust, by timing, and by the hope that no one would ask for all their gold at once. If that sounds familiar, congratulations, you've just reverse-engineered the foundation of modern banking. Fractional reserve. Banking didn't start with economists. It started with a practical observation. Not everyone needs their money at the same time. This tiny insight became the backbone of global finance. And it's the reason the world today runs on a system where money is less of a thing, and more of an agreement. What began as a goldsmith's quiet experiment would eventually evolve into central banks, government bonds, digital ledgers, and the invisible forces behind inflation. Fast forward to today. No more goldsmiths. No more sacks of coins. No more heavy vault doors clanging shut. But the trick? Oh, it's alive. Thriving. Scaled up beyond anything the goldsmiths could have dreamed. Here's the modern version. When you deposit $1,000 into a bank, what do you think the bank does? Keeps the money safe? Locks it away? Stores it in your account? Nope. The bank does the most counterintuitive legal move in finance. Your deposit becomes the bank's money. Not yours. Theirs. They owe you $1,000. But the physical money? It's now their asset. And with that asset, they can lend, let's say, $900. Someone else now has $900 newly created dollars. You still have $1,000 in your account. Money supply, $1,900. Nothing physical moved. but the world just got $900 richer. This is called credit creation, the hidden factory where 90% of the world's money is made. Here's the aha moment most people never realize. Banks don't lend out existing money. Banks create new money when they lend. This isn't a conspiracy. It's literally written in central bank textbooks, buried deep where no one bothers to look. Even the Bank of England admitted it in 2014. Whenever a bank makes a loan, it creates a deposit in the borrower's bank account, thereby creating new money. But here's where the twist kicks in. If loans create money, then debt isn't just a financial obligation. Debt is the oxygen of the entire system. Remove it, and the whole structure collapses. Increase it, and the economy expands. This is why modern economies push borrowing so aggressively. Home loans, business loans, student loans, credit cards, personal lines of credit. Debt isn't a side effect of the system. It is the system. If the system works so magically, why doesn't it collapse every Tuesday? The answer is surprisingly human. Belief. We all collectively believe. Banks are safe. Deposits are withdrawable. Money is stable. And everyone won't withdraw at the same time. This shared fiction keeps the system upright. But underneath the psychology is a very real mechanical engine. Leverage. Banks don't keep 100% of deposits. They keep just enough reserves to meet daily withdrawals and lend out the rest. But here's the second twist. In most countries today, reserve requirements are effectively zero. Banks don't have to keep a minimum percentage of your money. All they need are risk models, capital ratios, and confidence that tomorrow won't be the day everyone asks for their cash. This is why a bank run is so dangerous. Because the whole system is like a chair with 3 legs stable if no one moves too suddenly. You might think this sounds fragile, and you're right. But fragile systems, strangely enough, are often the most profitable. In fact, the majority of wealth creation since the 1800s has come from one formula. Asset value grows faster than debts collapse. When credit expands, housing prices rise, business investment soars, stock markets climb, and entire nations appear richer than before. But when credit contracts, you get 1929, you get 2008, you get that eerie silence in the morning air before an economy starts coughing. The banking system is like a high-performance engine tuned for speed, not safety. It can sprint, it can roar, but it can also overheat. Yet for centuries, this engine has powered the greatest economic expansions in history. Railroads, factories, technology, globalization, the digital age. When credit flows, civilization moves. Enter the central banks, the Federal Reserve, the Bank of England, the European Central Bank. These institutions don't print. Most money banks do that through lending. But central banks control the weather of the entire system. Here's how. 1. Interest rates. Lower rates, more borrowing, more money created. Higher rates, less borrowing, money creation slows. This is why the Fed feels like a global thermostat. Housing markets rise and fall depending on the temperature Jay Powell sets. 2. Quantitative easing, QE. During crises, central banks buy government bonds, mortgage securities, and assets. This injects liquidity into the system. QE doesn't print money in the cartoon sense. It changes the balance sheets of banks so they can amplify lending. 3. Lender of last resort. When banks panic, central banks step in. The goldsmiths relied on luck. Modern banks rely on central banks. But here's the third twist. Central banks don't actually control money. They control the incentives that make banks create it. The entire system is a partnership. Banks create money. Central banks create stability. Governments create legal frameworks, and citizens create demand. It's a four-way dance that could fall apart if any one partner steps on the wrong foot. Which has happened more often than we'd like to admit. Let's strip away the drama and state it plainly. When banks create money, they're not creating wealth. They're creating claims on wealth. Every dollar created through lending is a promise backed by the borrower's future productivity, the bank's risk assessment, the central bank's policies, and society's trust. Money is not the asset. Money is the claim on assets. This is why the system can create money out of nothing. Because the nothing is actually people's future work converted into numbers today. When you borrow for a house, the bank is betting on your future income. When a business borrows, the bank is betting on future growth. When governments borrow, the bank is betting on future tax revenue. Every loan is a small-time machine, pulling a little piece of tomorrow into today. But here's the insight most people miss. If money is created from debt, then the real danger isn't borrowing too much, it's when borrowing stops. Recessions aren't just bad times. They're moments when money creation slows, when optimism falls, when fewer people take those bets on the future. Money disappears the same way it appeared, quietly, invisibly, through the simple act of repaying loans. In other words, money is created when we believe in the future. Money is destroyed when we lose faith. That's the true engine behind banking. So how do banks create money from nothing? Not by magic, not by conspiracy, not by some secret vault full of levers and gears. They do it through a centuries-old insight. Most people don't need their money at the same time, and most economies run on tomorrow's potential, not today's savings. From goldsmiths with paper receipts, to early banks lending beyond their vaults, to global financial systems supercharged by credit, to the central banks steering the tide, to the digital balances that update every time you swipe a card. The mechanism has changed, but the principle hasn't. Money is less of a thing and more of an agreement, a shared belief wrapped in mathematics, law, and trust. And yes, it can be fragile. It can wobble. It can break. But for hundreds of years, this strange little trick powered revolutions, built cities, raised nations, and connected billions of lives into one grand economic story. So the next time someone tells you banks create money from nothing, you'll know the truth. They create money from us, from our trust, our work, our choices, our future. That's the real alchemy. If you enjoyed this journey, you know what to do. Around here, we don't ask for likes. We let curiosity decide. This is Empires of Finance, where we decode the game so you can finally see the board. In a world where money shows up from thin air, the rarest currency is still understanding.